Hello, and welcome to our webinar, which will look at recent events in the world of R&D tax relief, including in relation to the current pandemic. There's a lot going on. I'm Margaret Savory, a director at James Cooper Creston. My particular area of expertise is in corporation tax for innovative and technology companies, including R&D tax relief and patent box. We are very much open for business and are busy processing many of our clients' R&D claims at present to help them get their refunds. Please note that the information in this webinar is headline only, and if necessary, always seek specialist tax advice specific to your circumstances. Right, let's get going. The primary aim of the webinar is to give you the latest updates on R&D tax relief. But to begin with, I will start with a refresher in case there are those listening who are not familiar with the UK scheme. This has been around for 20 years now. I will then look at various aspects of government policy in the current COVID times. Finally, in Budget 2020, there were some changes and announcements relevant to R&D tax relief, and I will cover these off in some detail. There are probably more slides here than I can cover in the allotted time, but I've included them for completeness and may well skip over them as I'm talking. You can come back and refer to them later at your own leisure. So, looking at the basics, this diagram boils the UK R&D tax regime to its simplest. Firstly, you have to be within the charge to UK corporation tax. So an LLP or partnership with individual members or a sole trader cannot claim this relief. Note that UK branches of overseas entities may be eligible for qualifying R&D tax relief and qualifying R&D that they conduct in the UK by the branch, as they will be likely to have a UK corporation tax presence. So having established that you are chargeable to corporation tax, there are two conditions to satisfy. You need both qualifying R&D projects, more on that later, and you also need to have expenditure in certain categories, as not all expenditure is qualifying. Finally, there are two schemes, the SME scheme for small and medium-sized enterprises and the R&D expenditure credit scheme, or RDEC, for larger companies. We will now drill down into the details. So firstly, the SME scheme eligibility. The SME scheme firstly has size eligibility requirements, and shown here are the definitions either for a standalone company or R&D work to you. In any of these cases, the SME scheme is unlikely to be available for projects which have some element of funding. Instead, you still may be able to make a claim under the RDEC scheme, or large scheme as it used to be known. So in terms of the SME scheme, what is the benefit? The relief is calculated by an additional uplift of £130 for every £100 of qualifying expenditure. So for every £100 of normal qualifying expenditure, say on R&D staffing costs, you get an additional 130 deducted from your taxable profits, making a total of 230 deducted from the taxable profits. If the company is profitable, this equates to a tax saving of 19%, which is the current UK corporation tax rate, on the £130 uplift, equaling £24.70. If the company is loss-making, it can either carry forward the losses, the additional losses caused by the uplift, for offset against future profits, or it can have cash back now and surrender the entire £230. That's the £100 of expenditure you already had, plus the £130 uplift, and you can surrender all of that for a cashback uplift. The surrender rate is currently 14.5%, and you can see how it's increased over the years. So the 230 would convert at 14.5% to £3,335 of cashback for £1,000 of qualifying expenditure. So a rule of thumb for every £100 of qualifying expenditure, if you are loss making, you can get broadly a third back as cash. So for the £230, that would convert to £333.50. I think I slightly uplifted it to £3,000 earlier. This can be very attractive to startups where cash flow is important. So what's the RDEC relief worth? The RDEC, R&D expenditure credit, is calculated slightly differently in that for every £100 of qualifying expenditure, there is a grant of 12%, a taxable credit of 12%. So you would get back a taxable credit of £12. This results in an after-tax benefit of broadly 10%. As you can see, the RDEC rate again has steadily increased over the years. Indeed, in the 2020 budget last month, it was further increased to 13% for qualifying expenditure on or after the 1st of April 2020, which takes the after-tax rate of benefit to 10.53%. In addition, the RDEC is accounted for differently than the SME scheme, and any tax credit received is brought in gross above the line, typically as other grant income, and then this is subject to corporation tax. The tax refund for the SME scheme is brought into the corporation tax line in the accounts. I have mentioned that there needs to be a qualifying project, and most delegates to an OBN Biotrinity event will in all likelihood be involved in scientific projects. But here is the definition. Key phrases are there must be an advance in science or technology in your project and the resolution of scientific or technological uncertainty. There are also mentioned certain qualifying indirect activities which support or enable the qualifying direct activities of doing the science. At the bottom of the slide, I have referenced the source of the definition, to which professionals such as myself and HMRC all refer. So it's been around now for at least 10 years in the current form. The second thing I said was necessary was qualifying costs. Here is a list of the costs that qualify for both the SME scheme on the left and the RDEC scheme on the right. Two things to note: that firstly, not all types of costs qualify. So for example, rent and rates are not qualifying costs for the purposes of R&D tax relief. The second thing to note is that whilst the lists for the two schemes are broadly the same, there are some differences, particularly at the bottom of the RDEC scheme. You can see that you can only claim subcontracted costs in certain circumstances. These are costs subcontracted to other companies or third parties. And then you can also get claims for contributions to universities, which you can't in the SME scheme. Broadly, qualifying costs, as you can see, are those of doing the science, mainly people, reagents, etc. It does not include capital expenditure, for which you would claim specific capital allowances. These are all items that go through the profit and loss account. Touching again on subcontracted costs, they can be a complex area, and there are differences between both RDEC and SME scheme. And I refer you to the HMRC detailed guidance if you'd like to look at that further. And just to remind you that broadly any subcontracted costs to third parties, assuming they're qualifying, are restricted to 65% of the invoiced amount. So that concludes the refresher part of the webinar. Again, it is worth seeking specific advice about any specific queries you may have relating to your particular corporate circumstances. I'm now moving on to the recent developments in the R&D tax relief world, which have been brought about as a result of the recent government actions in response to the coronavirus crisis, and also some considerations as how you might be able to access cash quicker at these times. I will drill down into these areas in a moment, but I will pick up the last point first. The deadline for making an R&D claim is 12 months after the statutory tax return filing date, which is normally 12 months after your accounts year end. So you typically have 2 years into which to make an R&D claim. So if you had a 31st of December 2018 year end, the deadline for making the R&D claim would be 31st of December 2020. These deadlines remain unchanged. However, if as a result of COVID you are unable to meet the deadline for an R&D claim, say it's a 30th of April 2020 deadline, HMRC say they may be able to accept a late claim. So submit it as soon as you can or are able to. There is guidance on this area on their websites as to the procedures to follow. Now, if we look at some of the other things listed there. Firstly, we will look at the Corona Business Interruption Loan Scheme, CBILS. This is an emergency loan to assist companies with turnovers of up to 45 million with their cash flow. However, this is notified state aid. The SME R&D Relief Scheme is also notified state aid. The thing is, you can only have one bit of state aid at a time for the same project, which is why, incidentally, if your company receives a large Innovate UK grant for a project, it cannot also claim SME relief for that project, as both are notified state aid. So just to reiterate, you would not be able to have both CBILS and SME R&D relief for the same project. I have talked with HMRC about this, and their view is that in most cases, the CBILS application will be on a general business basis, so should not be considered the same as the R&D relief, which is for a specific project. In conclusion, if you do apply for CBILS, check that you don't compromise your ability to claim SME relief for a particular project for current or future accounting periods. It might be as simple as checking the wording of your application. So make CBILS for global company-wide assistance, and then your R&D relief is for a specific scientific project, then it probably appears that you are not getting state aid for the same thing. And so you should be all right. However, as ever, talk to your tax advisor about your own circumstances. The next point I want to mention is the statutory requirement for the company to be a going concern in order to claim R&D tax relief. And this is applicable to both SME schemes and the large RDEC scheme. In broad terms, the law states that a company may only make a claim for R&D relief if it is a going concern at the time when the claim is made. A company is a going concern if its latest published accounts were prepared on a going concern basis, and nothing in the accounts suggests that its status depends on its receiving R&D relief. A company is not a going concern at any time if it is in administration or liquidation at that time. The HMRC manuals also state that if the company ceases to be a going concern after making an R&D claim, the claim is treated as not having been made. For starters, these rules still apply in these times as they are enshrined in the law. However, HMRC policymakers have said that as many of the statutory accounts on which the claims are currently based are prepared before the current COVID crisis, they feel that the going concern requirement may not have an impact. However, they are monitoring this area. If this does or will create operational difficulties, then they would like to hear about it, and it is important to discuss it with them or your tax advisor. Please just be aware of this rule when submitting current claims. In order to claim R&D relief, you have to file online with HMRC a set of statutory accounts for the year, i.e. those that are to be filed at Companies House, a corporation tax computation and return, which incorporates the claim to R&D relief, and you may also append an R&D report. At present, HMRC do not accept draft filings, i.e. R&D workings or a tax computation that are based on a draft set of accounts or tax computations. You need to have final statutory accounts. So what can you do now to speed up getting the cash refund? So some ideas to think about are, can you shorten the year-end process? If external accountants or auditors are involved, maybe talk to them, as some of their other clients may be delaying their audits or accounting processes. So they may have availability to work on your account now to bring the claim forward. Another idea is to consider bringing forward your actual accounting year end. I have clients with June 2020 year ends who are considering making it a 9-month period to 31st of March 2020, so that they will be able to file for a shorter period, but get that cash back quicker. Note that you must consider what other implications this may have, as there are Companies Act restrictions as to how often you may change the year end. Something to consider or discuss. Some companies have also checked whether the audit is mandatory. Many may have audits because investors want it, not because of Companies Act requirements. Having an audit can add time to the process, so if you don't have to have audited accounts, consider filing unaudited accounts this year. Finally, the good news is that HMRC are working hard to keep processing times within the 28-day turnaround for both RDEC and SME claims, and they say they have deployed extra resources to do this. We monitor the situation constantly, and they seem to be adhering to this at this moment. However, do not expect anything before that timeframe, and certainly do not try to contact them, as they will not respond, as they are focusing on processing the claims. Finally, a small admin point, but it's quite important, always make sure you include your up-to-date bank account details on the tax return. This simple step ensures payments are made by backs rather than a check, and that can get easily lost, and in times of lockdown may be sitting in an empty office. I am now moving on to the announcements that were made in Budget 2020 that affect R&D Tax Relief. Generally, they are all good news. Firstly, as I've already mentioned, it was announced that the RDEC percentage increased to 13% for expenditure incurred on or after the 1st of April 2020. If you do not have a 31st of March year end, you will need to ensure you keep track of which side of this boundary your expenditure is incurred, as you will have to calculate the part of the year prior to 1 April at a 12% tax credit and the rest at 13%. The next point talks about the introduction of the off-payroll rules into the private sector, and that is going to affect many businesses, including those engaged in R&D, as many use subcontractors. So what they've done is delayed it, and this is a welcome delay to the introduction of these quite complex rules. The next point is considering the discussions that have been going on for a long time within the R&D community about the need to update the definition of qualifying costs for R&D. I've referred to them earlier. As I mentioned, the R&D rules came into being 20 years ago, and this was before the concepts of the cloud, data centers, and the whole way we run IT and communications now. This bullet point alerts you to the fact that they are preparing a consultation document which will be open to the public and for comment in this area. Note that they haven't yet published the consultation document yet. Finally, a welcome delay was announced to the introduction of the PAYE NIC cap on SME R&D refunds, cash refunds for loss-making companies until 1 April 2021. This is a welcome respite and gives time for the government to work on the design of the cap. At the Budget 2020, they published responses to the initial consultation, which was held in May 2019, and to which many in the life sciences sector contributed. They also published a new consultation document, which is live now. I'm going to focus on this topic for the rest of this webinar, because this is an important piece of proposed legislation which could have an impact on many life sciences and startup companies. So let's think about the first consultation and the initial proposal for the cap. Initially announced in 2018, the PAY cap is an anti-avoidance measure designed to prevent shell R&D companies claiming R&D relief where all the R&D work is conducted potentially offshore by a subcontracted entity. HMRC were concerned about this and also experiencing large fraudulent claims in this area. To counter this abuse, the government proposed the reintroduction of a cap on the amount of refund given for loss-making companies, calculated as the lower of the refund required or 3 times the total PAYE NIC of all workers employed by the entity, the company. As you can imagine, uproar ensued, particularly from the startup sector. HMRC issued a consultation document looking at ways of mitigating this for genuine R&D businesses. Responses were made until 28th of May 2019, with many from the life sciences sector providing comment and suggestions. These responses were published at Budget 2020 and are available from the HMRC website. The key areas of the first consultation considered are listed here, and they were whether to apply a de minimis cap so that the smallest claims, the whole admin burden was removed, as they would not need to apply a cap. Consideration of related parties in a group, and consideration of the unused portion of the refund above the cap and whether to carry that forward for use in future years. So looking at the first proposal, well, they have introduced a de minimis cap of £20,000. So below that level, so if you get a claim of that amount, the cap won't apply. So the next point was looking at group and connected parties. The government have further agreed to include the relevant PAYE and NIC of related parties if you subcontract work to them. So say you are a subsidiary, you undertake R&D, but some element you subcontract to another fellow subsidiary in your group. Under this proposal, you could also include the relevant other subsidiaries PAYE and NIC in your cap calculation, thereby increasing the size of the cap and potentially what cash refund you could get. Note that the first consultation didn't include externally provided workers in this definition, but this is picked up in the second live consultation. And finally, the third thing that they discussed in the first consultation, this was not well received, so they're not pursuing that any further forward. So this brings us to the new consultation document, published in March at the time of the budget and open until 28th of May 2020. The focus is on further aspects of the design as listed here. In the case of related parties, as I just mentioned, it is proposed to extend the inclusion of PAYE NIC to externally provided workers from the said related party. The second proposal is to remove the cap altogether in situations where 2 hallmark tests are satisfied, and the 2 tests are active management of IP and subcontracted costs being below a certain threshold. So if we drill down further onto these tests, the consultation document gives some indicators as to what would constitute active management of IP, and they consider what evidence might be required from a company. They cross-refer to the conditions for the patent box, which has similar clauses, and they are interested in knowing the activities that you undertake to manage your IP and what evidence could be provided, although they acknowledge there might be an additional admin burden. In terms of the second area, the proportion of R&D, they're suggesting 10% as the threshold, and they want you to comment on whether that is appropriate or what percentage applies in your company. It could be much higher, it might be lower. Putting all these proposals into a diagram looks something like this. So starting at the top, you are uncapped if you are below 20,000 in terms of your R&D tax relief cashback that you want. So you can be uncapped, or if you satisfy both hallmark tests. And if you satisfy both hallmark tests, as we've just described, then you will also be uncapped. Otherwise, the PAYE cap will apply, but its scope will also extend to relevant PAYE and NIC costs of work subcontracted to related parties. And to recall, the cap will be 3 times the total PAYE and NIC of your company, plus if there is relevant PAYE NIC from a subcontracted or externally provided worker entity. In terms of the specific questions asked, I have paraphrased them here, but won't go into them now. There are 5 key questions. And if you want to see the actual consultation document and actually look at those questions in detail, here is the link to the consultation document itself. If you would like to respond directly to the government, then I urge you to do so. HMRC do value your feedback and want to ensure genuine R&D activity is not penalised unduly. They certainly listened to all the results of the first consultation document. We will be canvassing opinions from our clients and drafting a formal response to the consultation document before the close on the 28th of May. So feel free also to contact me with your thoughts and considerations. Finally, to recap what I've covered today, I reminded you of the rules of R&D in the UK. I have alerted you to a few practical considerations in these times of cash flow need, particularly the going concern rule. And finally, taken a look at Budget 2020 developments, including the PAYE cap, which is an ongoing dialogue at the moment. So that concludes the webinar. If you would like to know more or you wish to seek our specialist advice, then please contact me. My details are listed here, or please visit our website. Thank you.